The Bank of Canada's rapid reduction in interest rates has the big question of whether or not you should be choosing a variable or a fixed rate mortgage once again on the minds of Canadians. And in this video, we're going to discuss whether or not you should be taking a 5-year fixed or a variable rate or a 3-year fixed or whatever mortgage it is you're thinking about taking. And we're also going to discuss the intricacies of if you do choose a variable rate, so that you don't fall into some of the traps that many of the people in 2020 and 2021 and 2022 fell into when they ran to their banks for variables without understanding the difference between adjustable payments, fixed payments, and everything else that comes along with getting a variable rate. Because when it comes to getting a mortgage, getting a fixed rate is complicated. Getting a variable rate mortgage is exceedingly complicated. It is the equivalent of choosing a mortgage that is essentially like trying to time the stock market. So you have to understand exactly what you're getting, how you're getting it, and in most cases, it's probably a good idea to have some help from somebody who isn't just picking a variable rate mortgage for the very first time. But before we get into it, my name is Nolan Matthias, and if you want the latest Canadian real estate and financial news, this is a place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. And if you are in the market for a mortgage in the next little while, make sure you get my book, Mortgage Secrets. You can get it totally for free. Just pay the shipping and handling at mortgagesecrets.ca. It will give you the tools that you need in order to make sure that you have the information you need to choose the right mortgage, negotiate with your bank, negotiate with a broker if necessary, and really just make sure that you don't have any blind spots that could get you in trouble, like many of those people who chose those big bank variable rate mortgages back in 2021, 2022, and so on and so forth. Okay, so let's get into it. Let's discuss what's going on with interest rates, because obviously the Bank of Canada is dropping interest rates quickly. Whether it's 25 basis points or 50 basis points, rates are going down. And that leads to the question of, should I be choosing a variable and taking advantage of the lower interest rates as they come, or should I be choosing a fixed rate mortgage? What should I be doing? And I'm going to start by saying this. It all has to do with risk tolerance. The number one thing when it comes to choosing a variable or a fixed rate mortgage is understanding your risk tolerance. And if you do choose a variable rate, understanding what your future worst case scenario could be and how you can mitigate the damages if interest rates do turn and start to go up, which, by the way, with interest rates going down, that's inflationary. And if they make another mistake and lower them too much, we could see them raising interest rates really quickly once again. That is something that has happened in the past, especially in interest rate environments where things are starting to get inflationary. And look at the 1980s where we saw interest rates go up quite substantially over a long period of time, with moments where it seemed like the worst was over, only to have it get significantly worse later on down the road. And here's the reality. The future, nobody knows what the future holds. We could go back into low interest rates for a long period of time. We could go up into higher interest rates. It's anybody's guess at this point. But right now, what we know is that fixed versus variable rates is a very difficult decision. So let me jump in here, and I want to show you first what the current market looks like with respect to interest rates. So this graph, it shows 2, 3, 4, and 5-year bond rates. And these are the rates that are pretty much predictive of what the market thinks interest rates are going to do over the long term, but they're also the rates that are used to price fixed rate mortgages in Canada. And I'm going to pump this out and make this a little bit bigger for you guys to see. And we're just going to go in here and take a look at what's been going on, because as of right now, what we're starting to see is, for the first time in quite some time, the 5-year bond yield is actually higher than the 4-year bond yield. And it's approaching the 3 and the 2. And really, most of the time, the way that this should look is that the lower the length of term, the lower the rate should be. So the purple line should be at the bottom, the 3-year line should be right above it, the 4-year line should be above it, and the 5-year line should be above that. And what you can see here is, if we go back to 2021, you can see that the 5-year rate was the highest, the 4-year rate was second highest, then it was the 3-year, then it was the 2-year. This is what it should look like. The shorter the term, the lower the rate should be. But when we get into a scenario where interest rates are rising fast, things are inflationary, we can end up with what's called an inverted yield curve, which is usually an indicator of a recession. And the shorter term rates actually get more expensive than the longer term rates, because it is expected that over the long term, interest rates are going to come down. That's exactly where we've been for a while. What you can see is, if we get this pushed out to basically the last month, this 5-year is starting to rise. It's starting to get above the 2-year and the 3-year and the 4-year. And that is a sign that things are going back to normal, which means the 5-year mortgages are going to be priced the highest and the 2 years will be cheaper. That's the way that it should be. And in addition to that, the variable rate mortgages, which are based off the Bank of Canada's overnight rate, should be the lowest of all of them. Now, as of this filming right now, it is still more expensive to get a variable rate than it is to get a fixed rate, but that is probably about to change. So then the question becomes, should you be getting a fixed rate or a variable rate? And going back to the early 2000s when all the research was done on this, the data typically shows that the best mortgage to get is the one that is priced the cheapest at the time that you get it. So in the past, that has almost always been a variable rate. Now, last couple of years, fixed rates have been significantly lower. Now we're starting to see the point where variable rates are getting cheaper. They aren't quite back down to where the fixed rates are right now, but they seem like they're about to shoot past the fixed rates, especially if the Bank of Canada drops interest rates once again. So let's talk about what the differences are, and let's talk about what you need to know when it comes to choosing these rates. So I'm going to pop you in here. I'm going to show you our app that you can use to basically look at pretty much anything when it comes to mortgages. By the way, the link for this is in the description below. You can get it for your iPad, you can get it for your phone. You can run the numbers for yourself. It's totally free. But when we take a look at a fixed versus variable at the time of filming here, a variable rate, once the banks lower their prime rates, which should be today or tomorrow, a variable rate is priced at about 5.05%. Now, a 5-year fix is priced at about 4.54%. So what this means is that there's a difference of about $144 in payments. The variable rate as of right now is more expensive. And as you can see, that translates to about $12,000 difference in interest. But if the variable rates do come down, what we are going to end up finding is that in all likelihood, 3 to 6 months down the road, a variable rate could be substantially cheaper than if you chose a fixed rate today. So many people are choosing right now variable rate mortgages, expecting that those variable rates are going to come down below what the fixed rates are. And as a result, they're going to end up saving money. Now, here's the thing. There is a whole bunch of stuff that comes along with choosing a variable rate that you need to understand. First is that there's no guarantee that the rates are going to come down. If all of a sudden inflation spikes, if all of a sudden something happens in the economy or something happens in Saudi Arabia where they start flooding the market with oil and oil prices come down and that hurts the economy, or OPEC starts pulling back the amount of oil that's available and all of a sudden oil prices go up, well, we could find ourselves in a situation where we're back into inflation and interest rates start to turn again. So it really comes down to one is what is your expectation? And then are you willing to roll the dice in order to take a variable rate in hopes that interest rates do go down? Now, the next step after that, once you've decided if your risk tolerance is such that you're willing to take that bet and take that chance, then you have to choose the right variable rate. And the key thing here is that you cannot go to your bank for a variable rate mortgage for a couple of reasons. The first is obviously that they have typically static payments unless you get one with Scotiabank, which means that as interest rates fluctuate, if they do end up going up somewhere down the road, you could find yourself in a trigger rate position like many people found themselves in the last couple of years. But there is an even more important reason why you shouldn't be choosing a variable rate with a big bank unless it's Scotiabank. And that is because if interest rates do go low and you get an opportunity to get a lower interest rate, lock into a fixed at a significantly lower rate, well, if you've got a big bank mortgage, a big bank variable, you're going to be at the mercy of the big bank when it comes to the rate that you can lock into. And then at that point, they get to basically dictate, well, you are going to be given this rate. Maybe instead of 4.54, they give you 5.04, or they give you 6% when the going rate is maybe 3.99%. And at that point, you've got a decision to make. Do you lock in with that big bank, or do you pay the penalty and go elsewhere? Now, here's the thing. If you decide to stay at the big bank, now you've got a fixed rate mortgage that you've locked into. And because of the way that the banks calculate their payout penalties, the potential penalty if rates go down further, or if the 2-year or 3-year rates are significantly cheaper than what you're paying at the point where you decide to pay out your mortgage, let's say it's before 5 years, which by the way, in Canada, on average, people last about 3.67 years in their mortgages. So there's a high likelihood that you may incur a payout penalty. Well, that payout penalty could be astronomical because when you get a fixed rate mortgage at a big bank, they always annotate the discount. And that discount is not so much a discount, it is something that is designed to artificially inflate your penalty. So if you look at like First National or an MCAP versus pretty much any of the big banks for fixed rates, you're looking at penalties that are typically 1/3 to 1/5 the amount that a big bank penalty would be. So if you're going to choose a variable rate, it's important to get the right variable rate from the get-go, which means you get a variable rate with an adjustable payment. So as interest rates come down, your payment's also going to come down. And if you do decide to lock in, you want to be with a lender that only has one set of rates, which means you're going to lock in at the best rates rather than having to negotiate with your bank or leave the bank or expose yourself to a massive penalty. Because I cannot emphasize this enough. Banks love to say that companies like First National and MCAP are B lenders. They're not. In fact, the business that they do is typically more prime business than what the banks can do because of the way the investors want the mortgages. And in reality, when you look at the product differences, the monoline lenders, the mortgage specialty lenders like the First Nationals and the MCAPs of the world actually have a better product. It has lower penalties. It has adjustable payments on variables. The reason why they have better products is because they have to. If they didn't have better products, they wouldn't be able to compete with the big banks. And when it comes to products, B is for banks. The real B lenders are the actual banks themselves, unless you're looking for a specialty product like a home equity line of credit or something else that a typical non-bank lender can't do. So if you are going to choose a variable rate, you need to make sure that you're choosing wisely, and it probably makes sense to have a good broker. Now, if you don't have a good broker or you want a great broker, my team at Mortgage 360 would be happy to help you choose the right mortgage. Make sure you have a mortgage that's going to have a low payout penalty, one that you can lock into at the best rates if you do decide that you want to take advantage of a fixed rate mortgage when they do get cheaper and cheaper and cheaper if interest rates do go down, and one that isn't going to have a massive penalty when it comes time for you to move. The most flexible mortgages at the best rates, that's what they can help you get. Oh, and by the way, if you want to see more about what's going on with fixed rate pricing and what the current rates are today, make sure you check out this video right here.